Well, hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our Friday All-Mailbag episode. We have the most random kickoff time ever, about 4:26 p.m. Pacific time. Boy, long story short, had a lunch in downtown Seattle today. It started late. I got out late. I got here to the studio late. Everything's been late. If I was a better planner, I would have planned ahead for like a 4:30 p.m. kickoff, and everything would have worked out pretty well. But here we are. Good news is the charts updated just fine. Markets are closed here for the week after this shortened holiday week. We'll give an instant reaction to what we observed checking in on the markets here this afternoon. And then I've hand selected 5 or 6 questions. I think it was 6 I ended up with to answer. These are all questions that have come from our live streams during this week. Also, questions that were sent in on our YouTube channel. So please take a moment when you can through the course of the next 5 or 6 days. Any questions that come up as you're analyzing the markets, as you're looking at charts, as you're trying to make sense of these crazy market events and their implications, we're here to help. Use the comment section on our YouTube channel or on any of our live streams. Just drop a comment in as we go, and maybe we'll feature one of your questions in our next All Mailbag episode. On Friday, what we like to do is do a quick check-in on how the markets close. I like to reserve some deeper thought and deeper perspective for my Market Misbehavior premium members. So quick plug there. If you go to marketmisbehavior.com/premium, you can learn all about our premium memberships. It's a ton of fun. It is a small and mighty group of like-minded investors, a lot of individual investors managing their own portfolios, some financial advisors managing others' capital. But at the end of the day, we're all trying to make sense of these markets, get out of our own way, make better decisions, and have more peace of mind that we understand the market, improve our market awareness. You can find more info at marketmisbehavior.com/premium. You too can check out our weekly flight plan, which is our main investment-oriented report. Also, our monthly chart review for June, which will be released at the beginning of next month. So act now. You get access to all of those and a lot more cool stuff as well. So here's what happened in the market today. Basically a choppy, sloppy, sideways day. The S&P and the NASDAQ both up, but less than 0.25%. The Dow finally, I think for the only day this week, actually outperforming the S&P and the NASDAQ. The S&P 600 small cap index, the worst performer. But the real news here, I would say a couple things as an abbreviated set of observations. The VIX continuing to go lower and lower. The VIX is now below 16. We're almost down to a 14 handle, which we haven't seen probably in a year or so. I don't know if we saw that in Q4 of last year. Before you get too excited, though, if you're all bearish and you're seeing a very low VIX and thinking, it's so low that it's probably bad news for stocks, don't get too excited. What I've learned in my experience is a very low volatility regime can stay very low for quite some time. Low VIX on the surface is not as negative as you might think. A rising VIX is what you want to be looking for. That's why I wait for a VIX to break above 20. For me, that's the red flag. Very low VIX just says the volatility is pretty negative. There was some action in the bond markets. Bonds actually sold off going into the close, a lot more than equities did. Rates generally basically remained flat for the day. Gold was up a little bit, about 1%. Crude oil prices down slightly. Cryptocurrencies kind of chopping all over the place. Bitcoin's currently just above 73,000, so well below those previous levels. The other big, again, just to jump around a little bit, I mean, today was technology and then everything else. The XLK was up 2.2%. The financial sector was up 0.6%. That's a grand total of 2 sectors that were actually up today on Friday, May 29th. Everything else was down, and consumer staples, the worst performer, down 1.8%, followed by energy and consumer discretionary. The breadth was kind of negative today. The big movements in the technology sector, right? So out of the Magnificent Seven and Friends of the Gargantuan Seven, I received as an idea this week. I don't know if that's it. We're still actively pursuing some different namings for this group of names that are no longer magnificent. So keep the thinking cap on and let me know if you have any ideas. But Microsoft up 5.5%, Broadcom up almost 5%, Nvidia down 1.5%, continuing that breakdown of a key trend line support. All right, that's as much of an update as I would like to do on today's episode because I would love to get to some questions. I know a number of you are watching live, and if you are, please drop questions as they go. We'll definitely try to keep an eye peeled on that one. But these are some questions that I've hand selected from all of you here over the last week, and thanks as always for sharing them. Question number one, and I summarized a longer question as such, with the top 20 stocks making up about a half of the index by cap. That's probably about right. I feel the number of all-time highs or number of new 52-week highs has lost its significance. This is earlier this week. We've been talking about new 52-week highs, new 52-week lows. That's a chart I reflect on pretty often. If the largest names are moving, and that takes a ton of money to do, why care about the crumbs? I love the way you phrase that. Why care about the crumbs? Here's the thing, right? You're absolutely right. And I can show you on Koyfin. This is a platform that I use to analyze ETF holdings. So here's the S&P 500, right? So you've got Nvidia at 8%. This is in the SPYs. This isn't exactly the mappings in the S&P 500, but pretty close. Apple at 7%, Microsoft at 5%, Amazon 4%, the other Alphabet 3.5%. So the two alphabets together, let's see, these are here right around 6%, 6.3%. Meta, Tesla. So you're absolutely right. And you have to get down to Eli Lilly, which is now one of the top 10 stocks, I think, by weight in the S&P 500 with the rally that it's had here. 38% of the SPY is the information technology sector, just that one sector. Financials are at 11%. So between financials and information technology, you're at about 40% of the S&P 500. So we have a very top-heavy situation in the S&P. And down here in the lower right, I don't know if you can see that very well, but the semiconductor group alone is 18% of the S&P 500. So the S&P is very much overly concentrated in those top names, and I think that's the point of your question, right? But you're adding another point, which is if that's the market, right? If the market is basically driven by these names, why look at breadth indicators, right? Why look at counting, these small, tiny S&P 500 names that are nowhere near the impact there? That's actually a really valid question. I think it goes back to what market breadth conditions really represent. Even when we don't have an over concentration like we do now, even when semiconductors aren't 18% of the S&P, even when tech alone isn't 38% of the S&P, we still have sectors that are bigger than others, right? Materials is always a tiny sector relative to something like financials or consumer discretionary, for example. So we've always had that situation where certain stocks are bigger, and we've had names that dominate, right? You got the Nifty 50 in the 1970s. We've had, in the tech bubble, you had a small number of names that have been big, and you always had names like Walmart and ExxonMobil that are just huge mega cap sort of conglomerate types of stocks. There's always been that issue. The whole point of market breadth analysis is you ignore that for a brief moment. Now, your question is, why do you do that? And because when you're analyzing the chart of the S&P 500, you're already considering those names, right? When I analyze the chart of the S&P, I'm basically analyzing the charts of those 20 stocks because they make up about half of the index. So if stock number 492 out of 500 has a really bad day, that's not going to be a blip on the radar of the S&P. So I'm already analyzing the trend of the S&P. I'm already analyzing the momentum. And by doing that, I am basically focusing some attention, if not a lot of attention, on those mega cap names. The whole point of market breadth is I'm already doing that over focus on the big names. Let me also think about the fact that it's not just a stock market, it's also a market of stocks. As an individual investor, one of the great advantages you have over a big institution is that you can own a bunch of smaller names if you want. You can sell out of Meta if you don't think it's a good chart anymore, and you can just buy some other stock if you want. As a big institution, if you're on a $50 billion mutual fund, you can't just be buying and selling shares of Meta when you feel like it. It takes you days, if not weeks, to accumulate a meaningful position. And even if you don't like Meta, you probably still have to own some of it if the S&P is your benchmark and you own a huge fund, just because you don't want to be completely naked that stock. You have to have some exposure. So one of the great advantages you have as an individual investor is that you can think about breadth and you can think about some of those smaller stocks that don't maybe register on the chart of the S&P, but could provide some opportunity to outperform. I would say, having worked with a lot of big money managers, one of the biggest challenges you have besides the liquidity, which is just when you want to add or subtract to a position, how do you get those shares or release those shares and not completely shock the market? I mean, that's one of the most painful parts of it. But it's also just the fact that you're not nimble, right? Take advantage as an individual investor, someone running a relatively smaller book of, a group of capital. Use that to your advantage. You can be nimble. You can change quickly. You can pivot and find names that that could be a great opportunity. While a big institution stuck in Meta that might be a horrible chart, you have the ability to just pivot and buy something else that's great. So the whole point of breadth is to really think about the fact that there are other opportunities out there. And so I would say that's any of those breadth indicators. They're all equal weighted. And that's because the cap weighted indexes already over accentuate the big names. We're already doing that. So let's, think about what kind of message we can get from other stocks out there. That's my soapbox discussion about breadth indicators. Huge fan. And I would say they still very much have meaning. And I would say ignoring those means you're not thinking about some really good potential opportunities for market color. Next question. Why do some stocks have large runs, sustained buying before earnings? For example, CrowdStrike, Palo Alto Networks, Hewlett Packard Enterprises, HPE. Let's look at one or two of those, shall we? CrowdStrike's a great example. So CrowdStrike just reported earnings. They actually reported earnings on March 3rd. I don't know if this is a great example. Oh, they're set to report next week. So I see that's what you're saying. It's already run up a ton going into earnings, right? So why do stocks have large runs before earnings? So, well, a couple thoughts on this, right? I don't know if CrowdStrike is the perfect example of that because it really started running back in, sort of completely off cycle, right? They reported earnings back here in March. It chopped around for quite some time. This is kind of mid-cycle when it popped up there. So a couple observations on the price to earnings relationship. Remember, earnings are a quarterly snapshot about what's happening with a particular company, but that's not the only time that investors get color on factors that could be driving CrowdStrike's business, right? So stocks will move for a lot of reasons, they often move significantly around quarterly earnings, but that's not, if that was it, then once a quarter we'd get together and then we'd all trade the stock based on what we thought about that new information. There's a lot of movement between those quarterly earnings reports, and that's driven by a lot of other things. It's driven by macro factors like interest rates, right? And inflation and economic indicators and consumer data and sentiment, news flow, like what's happening in the Middle East, what's happening with other companies, right? So just because CrowdStrike isn't reporting, other companies in the software group might be reporting this week. And so a stock will move up or down, sort of being, in relationship to a competitor that maybe had really good or really bad earnings. There's also, remember, the people that cover these companies are talking to the management team. I know, having worked for a big buy-side institution, we would have the management teams of companies like CrowdStrike come to our office once a quarter and talk to us about their business. And that would be not necessarily right on the earnings day, right? That would be another time. So we could sort of get some color, during the quarter. There's always sort of this idea that someone knows something, right? That there are these whisper numbers that people know and they have access to information. I will tell you again, I haven't been doing this forever, but my understanding is back in the day before there were a lot more, closely guarded regulations about insider trading. One of the advantages you had being a big money manager, you could ask questions and you would get a lot of really, sort of off the record insights about what's going on with companies. So you'd be able to anticipate what their earnings might look like. That's very obviously frowned upon and illegal. And so that is not really, most firms now, sort of post early 2000s have a lot of specific compliance rules on, making sure you're not restricted and making sure that you don't do any sort of insider trading. There's obviously a lot of ethical agreements that people like me and others sign off on when we have professional designations, agreeing we won't do anything like that because it's considered unethical. And so I would say the days of firms having, dramatic information you don't have access to, probably not really the case here. But remember, the people that widely cover these companies are talking to the management team. They're getting an idea. They're looking at suppliers. They're looking at the entire supply chain. They're analyzing the models and really thinking about, is this a time we want to be starting to accumulate? Do we anticipate that this company is going to be reporting good earnings? Not that they have information you don't, but just they're putting in the time to project what the company's growth trajectory might be. And if you start to accumulate stocks ahead of time, that's what could cause the price to move. So I would say it's the fact that it's the analytical process of what happens off cycle. Remember that just this one company reporting quarterly earnings isn't the only thing that's going to move the needle. There's a lot of news flow that happens. There's a lot of competitors that are reporting. There's a lot of industry conferences. There's a lot of interviews, either direct or indirect, where people can get a sense of what might they're all just trying to project what this company is going to do, and some people are actually pretty good at it, and so they're able to get ahead of things pretty well. That would be my take on it. I would say, having spent some time talking to others in the industry. Next question: using SPX and SPXL as an example. Oh yeah, this question came after our webcast earlier this week on or last week, whenever that was. It's a bit of a blur. It was earlier this week on stops, and we call it the art of the exit, and talking about different stop loss strategies. Again, you can access that replay through the end of the weekend. Go to marketmisbehavior.com/exit, EXIT. If you want to check out the replay, get it now before it goes in the archive, only accessible to our premium members. But this was a question that came, after that webcast. You said, can you elaborate on using trailing stops on leveraged ETFs? I think you said they don't work well and that the stops should be placed on the underlying index. Yeah, I did mention that in passing. I feel like looking back, I probably should have spent more time on it, because you're not the only person that wrote in with some questions on this. So to use your example, you said like the SPX, which is here, and then the SPXL. So the SPXL, again, this is not an ETF that I don't believe I've ever traded. I don't do a lot with leveraged ETFs, but I'm familiar with them. SPXL is the direction kind of triple bull S&P. So the idea with products like this, a leveraged ETF, is it uses some derivative, some interest rate derivative, some swaps or something to artificially create 3 times the movement in the underlying. So if the S&P goes up 1%, this is designed to go up 3% for that day. If the S&P 500 is down 1%, this should be down about 3% on that one day. Remember, it's designed to match the leverage version of the returns for one particular trading day. So over time, it may not track exactly the return profile because of that daily relationship, but that's kind of what it's designed to do. And so I made the point of, look, if you're trading SPXL, which personally I'm not, but if you were, I would personally use the SPX itself to put a stop, like, and actually use that to identify when I might want to, acknowledge that I'm wrong and get out of the SPXL. So your question is, why don't I just use this for stops and put my stops right on the leverage chart? So the short answer is you definitely can. And I know some people that do that, and that's totally fine. The reason for that is, of course, this is where your money's tied up. And so if you want to calculate percent limits or percent stops or something, or use the moving averages or whatever, the chandelier exit, whatever approaches we talked about, why not use it on the thing that you're trading? Here's the thing with leveraged ETFs and with inverse ETFs, I kind of put in a similar bucket. I know they are tradable instruments, but at the end of the day, they're all basing their calculations on the underlying security. So if you look at the chart of the SPXL, which is this, and if I flip it to the chart of the SPX and I go back and forth, I mean, they're literally almost identical, right? I mean, the relative strength at the bottom is different, but besides that, I mean, if you look at the price series itself, it's almost the same. And so the moving averages and the and everything scale because of just the math behind what's happening with the leveraged ETF. So I would say if you would put a stop on one of those charts, I would say your stop is most likely going to be triggered on the other one on or about the same time. The reason why I use the underlying is, I would say, with like a percent stop, what you have to remember is a lot of those leveraged ETFs have much bigger percentage swings. So like an 8% stop might make no sense for a leveraged ETF, because it might just naturally hit that because the average true range is just much wider. So generally, I do my analysis and I think about entry and exit on the chart of the S&P, and then I use the SPXL or the SH or whatever leveraged or inverse ETF I'm thinking about, just as the way I'm trading that underlying stock. It's kind of like if you were using index options, right? Like I wouldn't chart the option. I would chart the S&P and then use options, an option trade as a way of making a bet based on my analysis of the chart. So for me, when I'm thinking about when to get in and or when to get out, I do my analysis on the underlying security, and then whether I use SPXL or like the double leveraged ETF or just the single leveraged ETF, for me might just be one of those things I think about, which is like, how confident am I in this position? How big of a bet do I want to make? Do I want to use leverage to enhance that exposure or not? But that's not based on the chart of SPXL. That's based on the chart of the S&P 500. It's kind of a roundabout, long-winded answer, but I hope that helps you make sense. For me, leveraged ETFs, less helpful for analyzing trends. I really don't analyze the charts of those leveraged ETFs too often. I analyze the S&P or the QQQ or the SMH or whatever that underlying thing is. And then I think of the leveraged ETF as a lever I might pull, as a way I might express an opinion on the underlying security. So the underlying security is where I do the analysis. That's where I would think about getting stopped out. That would be based on something that happens on the chart of the S&P, and then I would change my position on the SPXL because of that. And probably that's one of the reasons why I don't use a lot of leveraged ETFs, because I'm not super comfortable with, looking at a number of different charts just to think about validating those trades. And the other point, again, leveraged ETFs. I think someone just mentioned this in the chat. They're really not designed for long-term exposure either, so I don't really use them for long-term positionings too often either. All right, before we continue on, I've got 3 more questions to grab for you, but I do want to mention one of our partners, Koyfin. I've used this platform for a number of years. I'm a big fan of it, and a couple things I use almost every day that I will show you, besides just the main dashboard, which I usually have on one of my monitors in my home office. I also use it for ETF holdings. We ran this earlier on the S&P 500. When I bring up an ETF as part of my normal due diligence process, I love to think about what exposure I'm getting, sort of look through, not just the ETF ticker, but if I buy the ARK Innovation Fund, which I do currently own in an account, or something else, like what exposure am I getting? And Koyfin really is able to take the holdings and then put it into some really cool analytics. So I can think about weightings and think about what kind of bets I am getting when I own that stock. That can help me to think about unintended consequences, right? I own 4 ETFs and they all have a big Tesla position. All of a sudden I have a Tesla portfolio that I may or may not want. I probably want to be aware of that. I like to think about sector weightings and what sectors I may have more or less exposure to, and also some industry groups. But you can also run attribution analysis. So I can say year to date, which stocks in this portfolio, in this ETF, have generated the biggest returns or had a biggest contribution to the return of the ETF, which stocks have been dragging on the returns. That's something that we would do all the time in an institutional environment, something I really have found valuable to understand what returns are being generated and then how those returns are actually surfacing. One of the other things I love to do on Koyfin is chart the assets under management. I always want to know, if I'm looking at a particular ETF, what are the assets under management? What have the flows been like? And so they have great data on rolling flows. Have a rolling monthly flows just to see overall, are investors adding or subtracting to positions? What's the AUM? Has that been going up, been going down? Have they been gathering assets or not? How liquid is it? So if I eventually want to sell, how hard is that going to be? And I also use the earnings calendar a ton. This is my go-to reporter of record for earnings. When a company's are reporting, this is something I look at every weekend to just plan for the week ahead. All of that, if you want to learn more information, if you're an individual investor, if you're an advisor, I think there's great capabilities in different price levels for all of you. Go to marketmisbehavior.com/Koyfin. Make sure you use my link. That'll give you 20% off a new account. Thanks again, Koyfin, for being a partner to Market Misbehavior. All right, next question. I noticed you use the 21-day EMA, but for the 21-day exponential moving average, but for the 50 and 200-day, you use the simple moving average. Can you go into your thoughts behind these choices, and specifically into the 50 and 200-day exponential versus simple logic? Absolutely. If you've been watching my show for any period of time, you're probably very familiar with my go-to chart. It has the 21-day exponential moving average in green. It has the simple 50-day simple moving average in blue, and the 200-day simple moving average in red. That moving average combination, I've used different versions of that over the years. And here's why I use all three of them. The 200-day moving average is probably the most important one in a lot of ways. And the reason is because I've spent a lot of my career working with investors who are very technically oriented, but I've also spent great parts of my career working with and teaching investors who are not very familiar with charting. One thing I've found, though, with a lot of investors, whether or not they're big into charts, and regardless of how many zeros they have in the accounts that they're managing, they see, even if they're not big chart people, they tend to always know where the 200-day moving average is, right? I would have portfolio managers that were not big chart people, but they would always bring it up just to see where the 200-day was. And they would tell me, look, I don't look at charts a lot, but I know my competitors do. And I know when it hits the 200-day, something might happen. And so recognizing that we are getting to a 200-day moving average more often than not, that's just a level you want to be aware of. Most buy-side trading desks I've ever worked with, they all are looking at charts and they're all looking at the 200-day moving average because they know that happens as well. When stocks break through the 200-day, you often see big movements because a lot of investors use that as a signal of new accumulation or distribution. So the 200-day simple moving average, I think the value there is most people I've worked with kind of tend to know where that is. It's widely followed. As a result, I think it often ends up having some good signal. The 50-day moving average, I added a lot of time after that just because the market spends a lot of time pretty far away from the 200-day. And more often than not, I will find the 50-day moving average in a downtrend will serve as short-term resistance. And I've often found that to be a good sort of initial level to think about. Just more often than not, you'll find little swings right around the 50-day moving average. And so I found that's an important level to watch as well. And again, also widely followed. I used those two as just a standalone set of moving averages for years. And then I had a number of people that I talked with over the years that all sort of used a shorter moving average. And I settled in on the 21-day exponential moving average. Exponential is important because it's more reactive. So anytime I've designed like trend following systems, including my market trend model, always uses exponential averages because those are much more sensitive. So when the market turns, the exponential averages will move a lot quickly because they're more weighted to the more recent data. And the 21-day setting just ends up serving as a fantastic initial stop. And I found this so many times when a stock is in an uptrend, just waiting for that break below the 21-day EMA just often gives you a really good initial sign that something's not great anymore. So when I think of charts like Micron and others that are having these really good moves higher, my thought is I'm just going to patiently watch the 21-day EMA. At some point, that's going to break. And that's when I'm probably going to start thinking about maybe this uptrend doesn't have the momentum that it did previously. So that's why I use that combination. And now I've used it so often that when I bring up a chart, the shape of those three moving averages tells me a great deal. And when I bring up a chart, I immediately just look right up here and I can tell the trend. Are we going up or down? I can see the moving averages. Are they sloping upwards or downwards? Are we testing key moving averages? That alone tells me a good amount about the trend and whether I might want to consider that stock for further analysis. That's why. Let's see. Whoops, hold on. I put a timer on that one. All right. Very nice debate with Dean Christians. I think this is from our Market Misbehavior podcast. We actually have 2 episodes recorded this week. Had some technology glitches, so hopefully the first those both will be out. Hopefully one out tomorrow morning, and probably another one out at the beginning of next week. We had 2 really good interviews to share with you, and I hope you enjoy them when they're ready. But I did interview Dean Christians a couple of weeks ago, and if you missed that one, go over that one. He's a really thoughtful strategist, had a really successful career, and a really good process of using charts as a trend follower. And I thought he had some really good points to make there. Is there a good indicator or scan you use for the number of days above, for example, the 10-day moving average? That was something that Dean and I talked about, was looking for stocks that were above. And I think he said like 10 days above the 10-day moving average or something like that. And I actually turned, after talking with Dean during that interview, I actually created a scan. I'm happy to show it to you. I'm going to show you the stock charts version. So if you don't use stock charts, I'll explain to you sort of the methodology so you could probably figure out how to do it somewhere. Here we go. 10 days above the 10-day. So here's what you got to do. So on stock charts, these first 5 lines are just kind of setting the universe. I'm looking for US stocks, basically trade on US exchanges. It's not an ETF, market cap above 5 billion. I'm limiting this to just the S&P 500. Of course, you could change that. This series, this whole thing is what actually makes that comparison. And what it's literally doing is today we're above the 10-day simple moving average. Yesterday's close was above yesterday's 10-day simple moving average. 2 days ago's close was above 2 days ago's 10-day simple moving average. And it's literally just a big string of those very simple comparisons. It's not that sophisticated, but you could do that with any moving average combination with any number of days. So I'm basically doing today all the way through 9 days ago. So 10 straight days where every day we were above the 10-day simple moving average. That was a point that Dean made about a cool scan to look for stocks that are really showing strength, was just look for stocks that had been above a key moving average for X number of days. And so kind of thought about that and set up this scan, which actually I think is going to be set up as a sample scan on stock charts, because I think it's a pretty good one and a good group. If you run that scan, it's a really good group of stocks to review pretty quickly. So, or pretty consistently. So if you don't use stock charts, I apologize. That's the stock charts version, but hopefully you can find that. That is, it depends on the platform and how much you can customize it, but on stock charts and I know on like Optima is another platform I use with really good scanning. You can do that. All right, last question, then we'll call it a weekend, folks. You must come across stocks you want to buy every day. I wish that were true. I often usually do come. It's hard to not come up with at least one name that looks pretty good, but I get your point. Having said that, how do you discipline yourself to keep the number of stocks in your portfolio to a reasonable number? That is such an awesome question. And I will tell you, here's the reality, right? How I don't talk a lot about how you actually structure a portfolio, because for me, that's sort of gets away from the educational vibe that I like to go for, and gets a little too much into, making a recommendation. Here's how you should set up your portfolio. I'm under no illusion that I really am aware of your particular situation. Whoever asked the question and whoever you are, you have your own portfolios and your own goals and everything. And that's why you either need to, spend a lot of time on that and/or consult a financial professional to kind of go through that. Someone who's licensed to make recommendations to you along these lines. But I'm happy to share with you some thoughts about how you can approach that question. One is to think in terms of bet sizing, right? So if you think about not allocating more than 2% of your portfolio to an idea, which if you haven't really thought in those terms, that's probably not a bad starting point. That's pretty good basic starting point, right? By limiting only 2% of your portfolio to a specific position, you are much less likely to absolutely destroy your portfolio if you're wrong about a stock, which is good. And you're, if you have 20% of your portfolio in one stock, I personally found it very hard to sleep at night when I've got that much exposure to one name. So 2%, 3%, 5%, someone in there is probably a good starting point to limit your portfolio, one position to that percentage, which means if you have 2% of a portfolio in one stock, that means you've got to have 50 stocks in there to have 100%, long position or 100% of a bet. And so there's quite a few names in there, but that's a limited number, right? And so I guess the way that I would think of it is I usually think of a portfolio as like the core and explore, right? So I have a core position, which is over half of my portfolio is probably in just some passive or combination of passive thing, right? The S&P type of things. And then I have an explore portion where I'm taking active bets. And in different portfolios, that explore portion has different sizes and maybe a different approach. But I would say for me, thinking about what percent I want to allocate out of that, little piece, out of that, explore portion, how much goes into each idea is something I'm very thoughtful about. And what that means is if I'm out of space, if I'm fully invested with that bucket and I find some other great idea, then I have a choice to make, which is, do I want to allocate more of my core position into active bets, which is something I might do when conditions all feel very constructive. And I think taking more higher beta opportunities might help me get better returns. Or the other option is I have to swap out something I own for something else. And that is a line of thinking that, again, on the institutional community, we would spend a lot of time thinking, right? It wasn't just about analyzing one position and thinking, do I want to own this stock? The question is, do I want to own this stock more than these other stocks that I own? And so thinking about upgrading your team, right? Think about you're managing a baseball team, managing a soccer team. You've got a like a rock star player that comes along the line. Is he good enough that you want to put one of your players on the bench and pop him into the lineup? And if so, then you make the change, right? But if not, then you don't. And so again, the analytical process is part of it, but then thinking about where it fits into the portfolio can be very different. And I would say a lot of times people get into trouble when you just keep adding ideas and don't think about the money management side. I would say one of the most important roles you can play putting on a portfolio manager hat, the way you want to think about your portfolio is not just can I find new ideas, but more, how am I regularly reviewing the positions that I do have, and what's my process for getting things off of out of my portfolio? Right, when something's not helping me reach my goals anymore, I better have a regular process of getting those out. We talked about that a little bit during the webcast earlier this week. By the way, was using some scans for stocks breaking a 21-day EMA, for example, to run regularly on your portfolio and just make sure, right? Am I getting out? Am I reevaluating positions that are no longer in the position that I'm really ideal for, or that are ideal for me? Hope that helps. And listen, those were some awesome questions. Really appreciate the thoughtful questions. And again, we received so many. I try to hand select some ones that I think will make for some interesting presentations and conversation. But please keep them coming. Always open to new ideas about topics to cover. And your questions really help me to think about how to evolve the content. Have a wonderful, joyful, restful weekend. I wish you a great weekend. We'll be back live for our Monday show, first trading day in June. In the meantime, remember, it's always a good time to own good charts. Take good care, folks.